What's going on? Appreciate y'all watching my videos. What's going on? What's going on? Trying to make sure my live working. Make sure my phone sit up here. What's going on? But anyway, so this video, I've been meaning to do this video for a while. Every time I jump on the video, it slipped my mind. But I wanted to talk about the power of compounding. So, like in a lot of my videos, I'm always talking about investing and saving your money and all that stuff. But, you know, I'm telling y'all, like, you really gotta invest your money out here. I mean, you really, because the power of compounding is like when you crunch the numbers and when you play around with the compounding calculator, the compound equation, future value equation, it's just mind-boggling, man. Man, it's just mind-boggling. So I'm gonna do an example here, and y'all can check my numbers. You can Google it, you can put it in chat, and you can go online and play around with different calculators. But so when you're looking at a stock, you want to ensure that you're getting the best bang for your buck. So, you know, I know a lot of people don't talk about this, and you got to get to the brass tacks of it all. Everybody say invest in the S&P 500. Everybody say and buy these stocks, buy this and buy that, but you really don't know how to compare and value one against the other to know whether you're getting the best bang for you. How do you know if a stock is overpriced? How do you know if a stock too expensive? You know, and it's not based on the stock price. You got to look at cash flow. You got to look at revenue growth. You got to look at dividend growth. You got to look at debt, debt to equity. You got to look at it's a bunch of things you need to be looking at. And so either it be a S&P 500. A S&P 500 in itself has growth in it, growth activity in it. And so you got to be able to look at it and tell that, okay, every month you put money in here, how do you know? So I'm going to do an example, right? I'm going to do an example of, it's a EFT called SCHD. It's the Charles Schwab High Dividend ETF. I'm sure a lot of y'all probably heard of it. ACHD. Okay? And so the dividend yield for SCHD is, the yield is 3.5%. The dividend growth is it's about 12%. It's about 12% a year. And so I know some other information that I need. It's some other things, but when you look at a stock, okay, let's take, for example, Visa. Visa right now is pretty much the best dividend stock on planet Earth. You can Google it. You can talk to any investor. Between MasterCard and Visa, they are the two top stocks on planet Earth, period. Purely based on growth rate. And so when you're talking about growth rate, that is your compounding. That's your compounding. You want that number to be high as possible. You want that number to be high as possible. And so when you looking at the compound equation, future value, the compound equation, let me take y'all off the thing so I can show y'all what I'm talking about. Let me switch y'all around. Okay, so I got this piece of paper. So if y'all can see it, this is the equation. That R number and that N number, that R number and that N number is the most important thing when we're talking about investing. And so when you're looking at a company, you want that R number to be high and you want the N number to be high. N is time. You want as much time as you can. And so if you got 5 years, you don't have enough time for your money to compound. You need more time. You need that N number to be high, which is a power. So if you took, any of y'all took 8th grade math, middle school math, you know the N number is a power. Let me flip y'all over again. So see that N right there? That's a power. So if you got 16 to the 5th power, 20, whatever, to the 20th power, that's time. So that's time in years. So that's like 2 years, 3 years, 5 years, 6 years, 20 years, 30 years. You want that N to be high. And you want the R to be high. R is the rate. Okay? R is the rate. And so when you looking, okay, so the P is present value. That's right now. So wherever you standing at, P is right now. So whatever money you got, that's right now. And you're going to put this into this formula and do the math. And future value is the output. So when you're looking at a company, an ETF, mutual fund, it's easy. You just need 3-4 pieces of information. You need the dividend yield. You need the growth rate. The growth rate, you need that. You definitely need that. So if you look at Amazon and you go on Amazon and you look at the stock and it shows that Amazon has got a 20% growth rate. So you take 20% and multiply that to how many years you got. That's going to tell you how much money you're going to have in the future. So let me do an example for y'all so y'all can see how powerful this is. This is just so powerful. All right. So I just got this little piece of paper and I was just sitting here and I wanted to do this video. This isn't nothing complicated. So you can look this ticker up, SCHD, and you can get this information right here, 3.5% yield with a dividend growth. Let me put this down here. Dividend Okay. Dividend growth rate is 12%. It's estimated about 12, 12.5, 12.2, somewhere in there. It's about 12%. So what does this mean? So if you have $500 a month, multiply that times 12 months in a year, that'll be 6,000 a year. And if we trying to see how much dividend income we're trying to get in 20 years, we want to know how much dividend income I can get off this ETF in 20 years. Okay? If I invest $500 a month, $500 a month, okay? That's $125 a week. Y'all can afford that. I know y'all can. So after 20 years, your own money, after 20 years of your own money, you will put in 120,000. 120,000 into this ETF, right? We want to know how much dividend income we get off this. We want to know how much dividend income. So if we do the math, we got to find out. First, we got to find out. I'm sorry, y'all, I'm trying to do this by hand, but we need to know there's a future value factor. That's what we got to know. So we can multiply this factor times this. Because we need to know how much 120,000 is going to be in 20 years before we figure out the income first. So to find out the factor, we do this math right here. We do 1 plus R. R is 8% because the stock market grows on average about 8%. We're going to use 8%. Okay, we're going to use 8% as the rate. So we do 1.08 to the 20th power minus 1. Minus 1 over 0.8. Because this is the formula right here. Okay. So basically, I already did the math already. Basically, once you do all this math, you would get 3.66. That's the factor. This is a future value factor. You can Google and find a chart. It gives you all the factors based on years and what the interest rate is, but we're doing it by hand to show you where you get this number from. But you can Google a future value factor chart and it'll give a list of all the factors. So when you can determine what is the future value of a number in 20 years, 10 years, 50 years, whatever the case. So instead of doing all this math, we know the future value factor is 366. And this amount in 20 years will be $275,000. Roughly. Plus or minus a few pennies. That's what this amount is going to be. $275,000. That's what that's going to be in 20 years. We ain't done yet. So now we want to know how much income our $120,000 is going to be. How much our $120,000 is going to end up paying us every year. We want to know what our $500 a month is gonna pay us in 20 years. Your mouth gonna drop. I'm telling you, your mouth is gonna drop. So now we gotta find yield on cost. That's the yield on cost. And so if the yield on cost is the present value, which is 3.5%, we move the decimal back. We get that number from up here. Now we're going to find the dividend income. So we get this number up here, 3.5% times the growth rate. The growth rate is 12%, 20 years. Remember, the n is to the nth power. Well, that's 20 years because that's time. So that's where we put that number. And if you do the math, you're gonna get 0.035 times. Well, you got to do this first. You got to do this math first. Sorry, you got to do this math first. So you got to do 1.12 to the 20th power. Hold on, let me do the math real quick. Let me do the math. All right. So I did the math. Look, y'all. Y'all see me do the math right here live. I didn't do no fishy stuff with the math. So this is the factor. The yield on cost factor, YOC. Okay? So that's the formula right there. That's the formula. Basically, you take the growth rate to the 20th power. We use 20 because it's 20 years. We want to know what the income is going to be in 20 years. So it's 1.12 to the 20th power. You get 9.64. Multiply that times our yield, because we want to know what the yield is going to be in the future. That gives us 33.76%. Now we can take that number and multiply it times that 275,000 and see, look, we invested $120,000 over 20 years. We put in $500 a month over 20 years. It gave us this. We found the factor. We got that factor. And where the factor at? Yeah, we got this factor right here, 3.66. Multiply that times 120, it gave us 275,000. We found our yield on cost. Okay, our yield on cost. We did all this math right here. You can check me. You can put this in chat, Google it. You can check me. And so once we did all that, we invested $500 a month into SCHD for 20 years. We getting a dividend income of $92,845 a year. That's what we get in a year. All for investing in ACHD for 20 years. $500 a month. We talking about, this is a pension. This is the dividend payout. You get a dividend payout of $92,000 a year. $92,000 a year. And I just did the math right here in front of y'all. $92,000 a year. Y'all want me to go through it again? So we talking about a dividend income that's going to pay us every year for the West, as long as we own this ETF. As long as we own that ETF, that's what we're going to get. That's what we get. That's the power of compounding. All that day trading and all that y'all doing, it's not going to do this for you. You ain't got to day trade no more. You just own this ETF and you just get it for the rest of your life. Every year, you're going to get $92,000 just because I did this math. The dividend. You got to understand how dividend work. You own Pepsi Cola. I think Pepsi Cola's dividend is paying 2.5 somewhere in there, 2.8 somewhere in there. Coca-Cola 2.8 somewhere in there. But the problem is Coca-Cola and Pepsi and them, their growth rate is low. You got to have a combination of growth rate and yield. That's what you're looking for. Right now, Visa and MasterCard got the best performance out here. It's when you're talking about dividend. When we're talking about dividend. I'm just gonna tell you, man. Math, if you ain't doing the math, man, I don't know what else to tell you. You just running around with your head cut off. You're not doing the math. You got to do math. Yep, no crypto, no crazy forex. You just own a companies. You just own a bunch of companies. SCHD owns a bunch of dividend paying companies. So ACHD doesn't do a bunch of tech. It doesn't do a bunch. If you look at the portfolio that's in ACHD, it don't have a bunch of crazy exotic stuff in there. It's got strong cash flowing companies in there. Procter & Gamble, Verizon, Cisco. I mean, these are old dividend kings. It's basically invested in all the dividend kings. The dividend aristocrats and the dividend kings. And so this ain't no crazy junk here. I mean, I don't know what else to tell you. And so, like I said in my last videos, man, you got to understand the mechanics of the compounding equations. You gotta learn these, because if you don't, you watch my videos and then you think I'm crazy and you don't understand what's going on. And so when you watch Fox Business and they're talking about this, that, and the third, you're not gonna understand what's going on, man. You're gonna kill yourself working your whole life and you're not gonna understand how money and business work. Just because you're doing this math right here. You gotta understand cash flow, free cash flow growth. Okay, you gotta understand cash flow growth. It ain't just having cash flow, you need cash flow growth. And there's only a handful of companies out there that's giving you that, you know. In the stock market, you're looking at probably like 10,000 publicly traded companies out there, 10, 11, 12,000 publicly traded companies out there. Only about 100 to 200 of them consistently over the last 20 years be able to grow their cash flow, grow their dividend, grow their revenues, you know, and so consistently. And so, you know, if you don't understand this stuff, you just be looking crazy. And so I advise to learn what I just said. Maybe type it in the chat GPT or something, Google it and understand what I said, because I did just a quick rough and dirty cell phone situation. And I know, like, you know, I know like what I said, you know, I was holding the phone and I just wanted to just show y'all real quick. I just wanted to show y'all. So when you looking at a company, you wanna make sure you hitting them 3-4 areas. Dividend growth. Ain't no point in buying a stock if you ain't getting no dividend growth off of it. You know, revenue growth. You need to get some revenue growth. You need dividend growth. You need dividend yield growth. The company just need to be growing. The company needs to be a monopolistic type company, you know, like Visa. Visa has a monopoly on the credit card industry. Visa and MasterCard, they dominate the consumer purchasing industry. So anytime you swipe a card, Visa getting paid. Their overhead is low, their expenses is low. It's a dumb profitable business. Like, they just dumb profitable. They make like dumb money. Their revenue growth is ridiculous, you know? And then so you got like a lot of other different businesses where they got a lot of overhead, they're carrying a lot of debt. And so when you look at, for example, Verizon or AT&T, AT&T has a dividend of, I think, 6-7%. But you're not taking home the whole 6-7% because half of it, more than half of that dividend is going to pay down debt. So AT&T, if you look at their debt, they have like a ton of debt compared to their free cash flow. Sometimes they don't even have free cash flow. Think about it. If you got a job and you make $50,000 a year and your bills are $60,000 a year, but you only make 50, you don't have any free cash flow. As simple as that. And so when you look at a business, you look at their financial statements, their income statement. They made $5 billion last year. Then you go through their expenses and all that, and then you look at their free cash flow. You look at their balance sheet, you look at their income statement, and you look at their financials, and it shows that they don't have no free cash. They got a negative. They got a negative. Not just 1 quarter, but 2 quarters, 3 quarters, 4 quarters. They taking on debt. And so therefore, that's a risky business. I don't want to invest in that business. I don't want to invest in that company. You look at their top line. You look at their revenue, the revenue row, right? Their revenue was $1 billion. Then it went down to $500 million, to $250 million. I don't want to invest in a company like that. When I look at a company and I look at the graph of the company, I want it to be going up like that. I want it to be going up. I want it to be going to the right, up and to the right. When you look at the graph, I want it to be going up and to the right. I don't want it to be going down. Most companies don't go like that unless they're doing something crazy. They're going out of business. But most companies go up, or they're stable, they're stagnant. Like if you look at Verizon's graph is very boring and stagnant. It's just stagnant stock. There's no growth there. But if you look at Visa's growth is like this. It's almost straight up. It's ridiculous. You know? Check me on it. Go on and compare the graphs of multiple different companies. You'll see what I'm talking about. And so that's what ACHD are invested in. Those are the companies that ACHD is invested in. And so I just did it right here in front of you. Right now, I think ACHD is the best dividend stock out here. I advise you to add it to your portfolio if I was you. In 20 years, you'd be able to get $92,000 a year, every year. And to be honest, it's gonna grow from there. It's not gonna stop right there. But I was just saying at 20 years. At 30 years, it'll be like 150,000. At 40 years, it'll be 300,000. You'll be sitting at the house getting $200,000 a year in 30 years on a dividend. And so that's what I advise. And I'm not on here getting stock advice. I'm not giving nobody stock advice. I was just saying, based on these numbers, I don't know, man. And so, but I've been planning. I've been meaning to do a video like this, getting into the technical minutia, nuances of calculating and comparing, stocks and companies and stuff like that. I'll probably do one. I'll probably do some more in the future, but that's what I advise. That's what I advise. My stream glitching. Yeah, you can catch it on the replay. You wish you started at 18? Man, it ain't never too late to start, man. It ain't never too late to start. Seeing when I can do equations. Mathematical equations. You stupid. The internet refused to acknowledge that African do calculate. Set it and forget it. Yeah, 92,000 forever, man. Long as you own the stock, you can. I mean, this is a ETF, ACHD. That's an ETF, but you can look at any dividend paying company and evaluate whether it's going to give you good return on your money. Whether it's going to give you good return on your money or not. No Forex, no crypto. No, I don't do that mess. I told y'all. You've been investing in fructose. Y'all funny, man. Y'all are too funny. But yeah, man, I just wanted to do this quick video real quick and talk to y'all about dividend income. Dividend income is a beast, man. You can retire off this. I mean, 20 years, put $500 a month. And this is just $500 a month, man. 500? I know a lot of y'all probably like, well, not everybody got 500. You better find $500 a month. I mean, cause stuff like this is retirement, man. Like, come on. Like, shoot. If I'm half wrong, you still getting $45,000 a year. If I'm half wrong, I mean, if you double it to 1,000 a month, you be looking at 200K. You're probably looking at more than 200K in 20 years. 200K a year. I just did a simple one based off $500 a month over 20 years. I told y'all, I keep telling y'all, whatever you spending your money on, I hope it's worth it. Because when you get 60 years old, man, and you trying to figure out how to pay the light bill, man, all you had to do was just invest a little bit of money. Shoot, if you invest $250 a month, you got $45,000. You know, if you do $250 a month, you do half of it. That's $45,000. $45,000 plus Social Security, you get about $25,000-$30,000 in Social Security with $45,000. I mean, that you're not a millionaire, but I mean, it's something. It's something, man. I'm just saying, it's a little something. You know, it's better than working at Walmart or working as a security guard at a hotel checking folk in. You 65, 70 years old. It's better than digging ditches. I tell you that. If y'all do half, $250 a month. Do $250. Can you do $250? I don't want your money. I ain't trying to sell you nothing. I'm just trying to help you put this information out here. You know, because I know truck drivers, we work too doggone hard, man. We work too hard, running up and down the road, 150 hours a week, man. Like, come on, man. That's all I'm saying. I'm just trying to help y'all. So, I hope some of y'all take my advice, and I hope this open your eyes up to evaluating stocks and ETFs, because not every stock is created equal. Not every ETF is created equal. Some of these ETFs ain't even worth your time. Some of them ain't even worth your time, man. You putting money in it, but you buying a stock. Say you buying a stock like AT&T, got a lot of debt. They pay a good dividend yield, but they got a lot of debt. So when you buy the stock, you giving them money. There's a good portion of your money going towards that debt that they're paying. It's not efficient. That's just not efficient. It's not financially efficient. You want to invest in a business that's efficient. And when we're talking about efficient is revenue growth, free cash flow growth, dividend growth, low overhead, low expenses. You want to invest in companies that are dominant in their market. Whatever their sector is, you want the most dominant company that don't have any debt, little to low debt. The company is just running smooth, just a smooth operating company. Very low debt, low overhead. It don't cost a lot of money to run the business. Like, it's clean, very clean business. And so you want to look for businesses that are clean running. You don't like trucking businesses. Like, I love trucking, but as far as an investor, I'm an investor. I want to invest into a business. I don't feel comfortable investing in transportation companies because they got a lot of overhead. Trucking is a cash heavy business. It's not efficient. And so, I would consider Norfolk Southern or United Pacific or something like that, one of the rail companies. But that's it. That's pushing it. Norfolk Southern is okay. They have a little bit of debt, but it's not too bad. Their debt to equity isn't too bad. It's out of control. But their growth rate is low. They have a low growth rate. I mean, Norfolk Southern is not, the rail business is not a growing business. And so, like, their growth rate is 2, 3, 4% is low. You want a company that's growing 15%. You want their earnings, their earnings, their revenue growth, their profit, their dividends to be growing 10, 15%. That's a beast of a company. That's your compounding, that compounding power. You get what I'm saying? And so when you're looking at a company, you want those key things right there to be growing. And so you don't want to be buying a dead business, a stagnant business. And so, because a stagnant business won't be able to give you $92,000 in dividend income in 20 years. Um, and so you got to be careful. And so, but anyway, let me get off here. I said what I wanted to say. I appreciate y'all watching my videos, man. I see y'all next time.